S&P's hitting 5,000. We've seen earnings surprise to the upside. We have seen a broadening. We've been talking about it all week. We've seen healthcare and industrials hit new highs. Can we just enjoy this, or is there like a pothole on this road to 6,000 that we need to look out for?
I just think we should enjoy this. It's really very exciting. And I think a lot of the reason why we have seen 5,000 and very close to it today is the economy is stronger than expected, much stronger than most people thought, and that's leading to better earnings. And you know, Frank, that stocks follow earnings on the way up and on the way down. And right now, they're going higher. And you're looking at about 5% for the fourth quarter, the quarter that's being reported now. I think for the full year, you're going to see upper single digits to low double digits. And that's a nice recovery from last year, where this time last year we were in the negative territory. So, and you know what's kind of exciting is it's not just top line or organic growth. It's also margins. Margins are expanding because of productivity, because of pricing power, and also because the supply chains have been getting fixed and inflation is coming down. So you have that really powerful combination of better top line, better margins, so you're getting operating leverage, and that's what's fueling the earnings picture, and that's why the markets are doing what they're doing.
Stephanie, I think you're telling a lot of people what they want to hear. We're going to go over to Mark. And Mark, you're not bringing bad news, but you are looking at the technical side of things. So you're looking at the S&P and the S&P equal weight and that divergence. But give me a sense. We all know that the S&P is really tech-dominated nowadays, but weren't we expecting it to move higher because of tech? Is this a surprise to see this divergence?
Yeah, thank you, Frank, and good morning, and hello to Stephanie as well. Look, I think the market has started off on a little bit of a strange start, footing to start the year. Technology, which we know has done phenomenally well as interest rates have come down and inflation has come down really since last October. It's really been the beginning of the year, the first month, where the equal-weighted S&P really is at the same level we were at back in December, and that's not necessarily bearish. And as you remember, we moved up about 700 points from October into end of year, so literally a little under 2 months, and the market's up, about 20% very quickly. So that doesn't necessarily mean the market has to roll over, but it is important to see other groups start to participate, and we have seen that in recent weeks. We've seen evidence of healthcare now moving back to new all-time highs, industrials moving to new highs. Financials have started to participate. So while we're lacking in a few of the breadth metrics that we'd really like to see, we need to see indices like the Dow Jones Transportation start to participate. But in general, it is a healthy market. I think institutions have been, really slow to embrace it and really to chase a lot of the stocks that have carried this market. But that doesn't necessarily mean you have to sell it. As Stephanie said, we're in much better shape this year than we were last year. We just had the Russell 3000, which encompasses 95% of all stocks, hit all-time highs, and the MSI World Index also hit new all-time high territory. So the market seems to be in a sweet spot. Earnings have come in better than expected. Inflation continues to come down. Now we're seeing a Fed that's on the verge of cutting interest rates this year. So there's a lot to talk about.
So, Mark, I want to ask you a question. You said institutional investors, they remain skittish, they're a little hesitant, but that's actually bullish for the market. Why is that?
Normally, you want to look at sentiment like this from a contrarian perspective. And as of last week, we saw one of the largest outflows of SPY, the S&P ETF, than we saw since 2014. So that was really interesting, right ahead of the so-called Magnificent Seven earnings. So we've seen these rapid gains in many of the stocks that have changed all our lives for the better. But I think a lot of institutions have started to put on the brakes a little bit and said, well, it'd be nice to see a consolidation, and it's right to potentially take money off the table. It was an unusual, I think, exodus from the market over the last couple of weeks. And if anything, it just makes me think, people need to see that consolidation, but we're not necessarily going to get it as soon as people want.
Okay, not going to get it as soon as we want, but overall, it sounds like you're saying the market's pretty healthy. Steph, I'm going to come back over to you. You're looking ahead to what's become like a really key economic report, CPI. What do you think that could do to this road to 6,000? Is this possibly? Could this be the pothole that a lot of people might be worried about out there?
Well, it's a really big number next week for sure, but I think we are going to continue to see progress, especially on the rent side of inflation. And so, to me, you just step back. We peaked at CPI at 9.1. We're looking at about 3.4. This report next week could be under 3. And so that would be encouraging. And that is definitely in the direction of where the Fed wants to go. They want 2%. But if you look at other metrics like productivity going higher, employment cost index coming down, core PCE, all of it is showing progress. And so I do think, that 6 times of cuts for the Fed, that's off the table for sure. Is it 2? Is it 3? We don't really know, but it's coming. And that's very good. And that's hopefully good for the broadening of the market. I just leave you with some themes for this year: housing, cybersecurity, anything consumer related, onshore, and aviation. There's plenty of ideas out there beyond tech, although I still like tech too.
All right, Steph, don't leave us just yet. We got a little bit more to go in the segment, but I'm going to come back over to Mark.
Oh, great.
Mark, I want to ask you, we talked about the market broadening. One of the things we talked about here on the show this week was healthcare hitting a new high. The fact that healthcare is the second biggest sector, what does that tell you just about the strength of the market going forward and the possibility of it stumbling?
Well, healthcare had been a laggard for quite some time in recent years. So to see this sector come back so rapidly, I think, is a very encouraging sign for investors. And it's one that, normally is to some extent ignored. I think that we all have this focus on AI and technology, but to see groups like financials acting well, to see healthcare hitting new all-time highs, very encouraging. The medical devices stocks look phenomenal. The pharmaceuticals are very good. The biotechnology group is a work in progress to some extent, but the group, to me, still looks quite attractive technically.